What are clients investing in when they're buying the KKR Credit Income Fund?
Clients are getting a little bit of both our KKR's public credit business and KKR's private credit business, which we think is pretty unique. So they're allocating to really two strategies: our Global Credit Opportunities Fund, which is in the public space, which is really our best risk-adjusted returns we're seeing across all the traded credit markets globally. We pair that up with our European Direct Lending Fund, which is a directly originated private credit product to middle market companies across Europe. Much more higher income focused, but collectively with a downside protection. So it's a pretty unique product because you're getting both sides of KKR's credit business, the public side and the private side, and meshing that together for an income product with downside protection.
So Chris, can you talk us through the investment process and investment philosophy of the team?
Look, our investment process is a pretty thorough process and similar to what we're doing across all the different products across KKR, not just in the credit business, but also our private equity business. And it's more about not what creates a really good investment, it's avoiding the bad investments and tapping into that knowledge. Once we make that investment, it doesn't stop there. We have a portfolio management committee that meets quarterly and really goes through every name in the portfolio and re-underwrites our projections and our downside case scenarios. And that's an opportunity to see risk before they're really identified risks to the other market. It enables us to see trends and also see opportunities if we want to increase positions. So the process and the philosophy is downside protection, consistent process that we've been doing for years, 17 plus years from the credit business, and avoiding mistakes is the key part of it.
What are some of the hottest topics being discussed behind closed doors by your team right now?
Yeah, I mean, the biggest topics that we're talking about on the trading floor and amongst everyone, because we are now back in the office, is really the market construct and how it's evolved over time. The technicals in the publicly traded markets are definitely changed. And I think we should just get all used to more volatility in the market. And we shouldn't be scared of that volatility. I think that the volatility is a huge opportunity as long as you can be the liquidity provider and lean in those periods of volatility. So what's causing this market construct is really the growth of daily liquidity vehicles, where you have a mismatch of assets and liabilities. A lot of times you're buying less liquid assets like high yield bonds and leveraged loans with daily liquidity vehicles like open-ended mutual funds and the like. And what you're seeing is when you're seeing outflows or red tape in the equity market or a bad day in the equity market, you're sometimes seeing outflows where you're forced sellers that day, and then you have to find that marginal buyer. And that marginal buyer, a lot of times, is the opportunistic pools of capital. So we're spending a lot of time talking about the market technicals, and then the incentives of a lot of these mutual funds aren't necessarily incentivized to take risk. They're incentivized to mirror the index or measured by tracking error. One of the things we're most worried about in the credit markets is less about credit risk, because I think the governments and the Fed stepped in and extended that. We're more worried about price risk and mark-to-market risk. Because with a high yield market at 4%, to get that marginal opportunistic buyer sometimes involved, it can drop 10 plus points on a mark-to-market basis. But that's some of the things we're talking about. That, and then the second topic is transitory inflation. We're seeing a lot more inflationary data. It's hard to hire people. We're seeing cost inputs. And I think it's going to be interesting to see Q2 and Q3 results and be able to decipher what is transitory versus what is actually real-term, longer-term inflation.
Yeah, great. Thanks. Actually, you raised a couple of really interesting points there, and I'll start off with the transitory inflation discussion. Has that in any way impacted the team's kind of positioning, whether it's sector positioning, security positioning of late?
Absolutely. I mean, we're spending a lot of time ahead of it. And this is a topic that we've been talking about for months now. We're really re-underwriting a lot of these businesses. So anywhere where we're seeing wage inflation, anywhere we're seeing cost inputs, we're adjusting our base case scenarios or even our downside and seeing how those financials look like and how the cash flow looks like. And as a result, we'll often, decrease positions or increase positions if we think we get comfort there.
Yeah. Yeah, and the duration of the actual portfolio itself is relatively low, isn't it?
Exactly. It's a mix of floating rate loans and bonds, and so the duration is sort of around that 1.6.
Have we hit the bottom of yields? Do you think there's more downside, or is that really irrelevant to the way that you guys structure the portfolios?
It's not irrelevant. We pay attention to it. I think what you're seeing is it depends on which sector, what area, what industry is if you hit some of the lows or it's or some of you still have room for more spread compression. And it's very idiosyncratic right now. And I think the more flexibility you have to be nimble and agile and go in between industries or even asset classes between loans and bonds or private credit enables you to manage some of this sort of 50,000 foot view diversified way of there's nothing to do when in fact we're seeing a lot to do.
And again, I'm going to follow up on something you just highlighted there. The difference between a loan exposure and a traditional kind of high yield bond exposure. And I know in the domestic market, it's still something investors are kind of getting their heads around the concept of trading loans, etc. Could you maybe talk us through the portfolio's positioning between those asset classes and why you're, for example, leaning towards loan exposures at the moment?
In summary, we're seeing a lot of interesting opportunities across both markets. We're more heavily weighted towards the loan market with a combination across the syndicated loans because we're seeing some yield there. And one of the things we're worried about in the credit markets is this price risk and gap risk, which you have more from the high yield market from outflows and daily liquidity vehicles. And then the last thing I'd sort of just note is in our European direct lending fund, that is primarily all bank loans, all secured and all floating.
When we talk about that risk spectrum and, when we look at the monthly summaries that you provide to market on the portfolio here, a quick glance at it and you'll see that almost half of the exposures are in that CCC ratings bracket. Now, what can you basically say to investors to keep them reading? What can you say to alleviate their kind of concerns in the way that you guys possibly maybe manage these exposures, take them on, or even get rid of them?
It's consistent with how we've managed that strategy for over 13 years. It's not like right now we're reaching down the risk spectrum for yield because we're not seeing it elsewhere. It's consistent with how we've managed the strategy for a number of years. The other thing to note is most of those triple Cs were triple C at time of issuance versus us reaching down to a company that's deteriorating in credit quality to get yield. And so what ends up happening is we get comfortable through our network and due diligence of leveraging the 500 investment professionals across KKR, all the portfolio companies, all the resources we have. When we get there on the company, we sometimes get there a little bit more comfort going down the risk spectrum. And then if you look at periods of volatility, historical periods of volatility, that triple C has actually outperformed many of the double B or single B part of the credit spectrum. And so history from a performance standpoint has played out. And then finally, our default and recovery statistics across KKR credit and across this strategy have some of the lower defaults and the higher recoveries than what we see from the market or our peers.
Has the portfolio experienced any defaults? And if so, how has the recovery process played out, for example?
Look, we're going to make mistakes. And the key thing about when you're making mistakes in credit is, did you get the underwriting and the collateral and the secondary source of repayment correctly? And if you look at our historical track record in defaults and recovery, our defaults have been much lower percentage and our recoveries have much higher percentage. And then a big part of that is the due diligence we do up front, but then it's also tapping into the other resources that we have across the firm to maximize recoveries when we do make a mistake, because we have access to those experts.
You guys have been very transparent with your NTA, and throughout the entire process, we saw it, in the depths of last year's kind of COVID crisis, go sub $2, I think, or very close to it. It's now rebounded back towards $2.50, slightly above that. However, the share price continues to slightly linger, and it's almost about 10% below that. What initiatives is the team undertaking or has already undertaken to rectify this gap and to hopefully support the share price in its catch-up of the NTA?
it's super important to us to make sure we narrow that gap. And ultimately, I view this product as an income product, where the investors and our partners get comfortable that we're able to deliver a consistent income and consistent performance. And for the most part, if we can prove through time that we can deliver that, hopefully that discount narrows. A couple of things, we have been doing some share buybacks, which shows our support for the product and belief in the product. In addition, we just recently switched from quarterly distributions to monthly distributions, which I think will go in effect in August. So that should lead to a little bit more consistent income. And if you look at what we're delivering on an income basis, it is pretty attractive, particularly relative to some of our peer funds out there. And then finally, it's going to be more transparency. It's communication, it's transparency about what's in the portfolio. It's doing more of these types of discussions, and we're spending a lot of time looking at ways to get more in front of our partners and our investors. The more you hear from us, the more you get comfortable with our process, our underwriting, and our performance, that will naturally narrow down the discount.
Thanks so much for your time today, and we'll hopefully talk again soon.
Thank you so much.